What's going on, guys? It's Kyle. Welcome to the Stock Goat YouTube channel. In today's video, we are going to be covering the Sofi stock, and it looks like we got a little bit of a boost today because the CEO Anthony Noto came out live on Cnbc and dropped us a bunch of good, little hints on where the business is headed, the direction that they're looking for 2025, macro, credit. He gave us a lot of good information. It looks like right now the SoFi stock is green and the market overall is liking what he said. So what we're going to do in this video today is we're going to, watch the interview again. I know some of you guys have already seen the interview. That's fine. Watch it again. You might get, some more information to get you more confident to potentially buy some more shares. And then we'll, do a little bit of a, analysis on exactly what he said, things that I like, things that, the market likes. And today was a great day overall, guys, and we're going to be keeping you updated daily on all of the SoFi, breaking news. So be sure to smash the like button, drop a comment, and don't forget to subscribe to the channel, guys. We are literally, less than 3 weeks away from the SoFi Q2 earnings, and we could potentially get a nice acceleration in the back half of Q3, Q4, just to hit the type of comps we need to do to beat, the 2024 comps. But guys, I think 2025 is going to be a breakout year for SoFi if we guarantee those rate cuts, guys. 1 to 2 rate cuts. I'm not even worried about 2 rate cuts, potentially 1 rate cut. And we know Anthony Noto made a huge pivot that is going to just, definitely save him in the, next 1 to 2 years, where he dropped his, outlook from 4 to 6 rate cuts down to, 1 to 2. And that was, a great move that he made as a CEO. And that's also why you're seeing SoFi continue to show revenue growth. Unlike these other companies that went way too aggressive, like an Upstart, like an Enphase, these companies that are really, cannot recover from this high interest rate environment. And SoFi is still continuing to grow in this environment. And if they get a lower rate environment where they can refinance across the board, guys, we are going back to, 2023 revenue comps once again. That 30% range is what I'm potentially looking at. So, guys, let's get into the video. It's going to be a great video. I love seeing the SoFi CEO come out and stand up for the SoFi investors. Let's get into it. And guys, I want you to know that I'm doing everything on my end, to get retail investors, to diamond hand the stock and not sell out. You can see I was putting in the work last night, making sure I get these updates in as fast as possible for everyone to see. And you can see we got 66,000, views, on the upcoming CEO interview this morning. So guys, I'm doing my part on my end to make sure, we hold the line, and you guys are doing great. I listen to all your comments. So be sure to follow me on Twitter as well. It's at Kyle White Gold. I really appreciate the follows, on Twitter, because I'm really engaged on there, and you're going to get a lot of bullish information. So let's get into the video once again.
The CEO of SoFi, thanks so much for joining us here. Before we talk about your business, I want to talk more big picture about the conversation here in Sun Valley, specifically about the state of the economy. Given your purview through your business, as well as the conversations you've been having with other CEOs, what's your sense of the economy right now?
Yeah, I'd say the conversation really kind of pivots around 2 points. One is, where's the consumer, how are they performing from a credit standpoint, and where interest rates going in the economy. On the interest rate point, we came out of Q1 having reported 26% year-over-year revenue growth with really no growth in our lending business, which is a really strong quarter, and we're really pleased with how things have gone since then. We came out of that quarter thinking there'd be 1 to 2 rate cuts and positioned our business to do that, which would give us still attractive revenue growth, maintaining profitability, but just as importantly, having a strong balance sheet to take advantage of when rates go down. I think the consensus view is starting to come into picture, and people will believe we'll continue to get the data points on inflation, continue to see an uptick in unemployment, but not too bad, and we'll have 1 to 2 rate cuts by the end of the year, which would be really positive. As it relates to the consumer, we've seen really good trends in spending. We've seen really strong demand for refinancing personal loans as people are trying to lower their debt so they can make sure they're planning for the future. So overall, our company's performed really well in this environment. I'm glad we took the stance of lower rate cuts than everyone else, because it's positioned us now to benefit when rates start to come down. So I like how we're positioned. And for the first time, I'd say in 2 years, there's a more central consensus view about rates and where credit is. And credit actually has performed relatively well throughout the year. And that's something I heard from a couple CEOs last night. And we're really happy with where it's performed as well, in line with our tolerance levels and our expectations. So all in all, I think we're setting up for a pretty strong back half of the year in 2025 if we get the right fiscal policy.
Well, we're going to talk more about fiscal policy in a minute, but I just want to return to something you said. I know you've been introducing new things such as alternative investments, but also you mentioned you're not doing as many student loans. What is behind that policy, and where are you shifting your focus to effectively follow or lead consumers, and where you want to be growing the business?
Sure. As we came into 2024, there was a view that actually rates would be cut 4 or 5 times. And we believe that for rates to be cut that frequently there would have to be a recession or some type of underlying problem. It turns out we'll get 1 to 2 rate cuts, which is where we've been positioned. And as we thought about the environment and thought about how much we invested in our financial services business, our SoFi Money product, our SoFi Invest product, our credit card product, as well as our technology platform, we had an opportunity to drive really strong growth there at 50% and really pull back in the lending business to be more conservative, to wait to see where the economy shakes out, where interest rates shake out. And now we're coming into a picture where that's a lot clearer. So we've delivered really strong growth without really using the lending business to help drive it. And now we're in a position where, as we go into 2025, to use both.
Now, of course, your business all started with student loans. And then just last week, a federal appeals court allowed a key part of Biden's student loan repayment plan to resume, staying in an order that had temporarily blocked it. Now, there's been a lot of back and forth on this. But how does Biden's efforts to repay student loans impact your business? And how do you see some of these legal changes and sort of the whole appeals process and the outcomes impacting your business going forward?
Yeah, we've really focused on people that have private student loans. Those are people that are still managing their cost and giving them cost savings on refinancing their private student loans. And that's been a smart strategy. It's a much smaller percent of our business. We gave guidance that we'll do close to $2.5 billion of revenue this year. We'll see really strong growth from the other businesses. So we're much less dependent on it. The fact that we grew 26% year over year in Q1 with no growth in lending overall is a great indication that we've invested in other areas that are really paying off for us. And the response that we're seeing for consumers in our SoFi Money product with 4.6% interest rate, SoFi Invest product, as you mentioned, offering them alternative assets and now IPOs, we've seen a great response there, and it's allowed us to go after other growth areas and not be so vulnerable to the whims of where the political or winds are blowing as it relates to student loans. I will say this, we've done well with a high rate environment and uncertainty around credit. I'm really excited about what will happen when rates start to come down, and you can start to see the light at the end of the tunnel. When rates come down, we'll see a real pickup in student loan refinancing. Right now, there are people with rates at 7 to 8% student loans, but we only can offer them in the 6s. As rates come down, we can start to offer them in the low 5s and maybe in high 4s. So that business will pick up. Our home loan business had historically been a refinancing business. We've invested a lot in being able to do purchase home loans, and we're now seeing that pick up and gaining market share there. And we've recently made the decision on home equity lines to give people even lower cost of debt. So as rates come down, we'll see a real pickup, and as long as the economy is stable and inflation is stable.
So you've mentioned various ways that your business is growing, but your stock is way down. Stock's down about 35% year to date, down about 19% since your last earnings report. I know that you have earnings coming up in a few weeks, so you're limited in terms of how many specifics you can share. But what's your message to investors? Why should they hold on when the stock is down so dramatically?
Yeah. The thing that we can control is our strategy and our execution. And for the last 7.5 years, our strategy has been consistent and our execution has been consistent. We've driven good, steady growth. When I joined the company, we had less than $300 million of revenue in 2018. Now we're over $2 billion of revenue. We weren't generating profits. We weren't generating positive EBITDA. Now we're generating both positive EBITDA and GAAP profitability. So I'm really pleased with what we're doing. In terms of the stock, I'm equally disappointed. I'm a big investor. Our employees are large investors. What we've seen and what we believe is happening is that the group of fintech companies that have credit exposure has been really hit hard. And they've been hit hard because of the uncertainty around interest rates. When will interest rates peak? And when will credit peak? And as I mentioned, we're really pleased with where credit's performed. We expected it to pick up a little bit, but it's within our tolerance levels. So good sign there. And as I mentioned, 1 to 2 rate cuts would be welcomed and moving in the right direction.
And what about AI? Will SoFi be the one to bring AI to retail banking, and will that really accelerate your results?
Yeah, there's a whole spectrum of technologies that we use every day to ensure that our product is safe, it's reliable, and we can be a trusted partner. Where we want to use AI is to fortify those areas, but we also want to use it to answer 3 questions every day. Because this is a financial show and we operate in a financial world, people want to talk about interest rates and consumer spending. We don't spend a ton of time talking about the product, but we are a product company, and my vision for the product is that you open up SoFi every day and you go to your member home feed just like you would to your Twitter home feed or your Facebook home feed or LinkedIn home feed, but we answer 3 questions for you in a personalized way. What must you do in your financial life that day? What should you do and what can you do? AI allows us to take all the data about you and everyone else and answer those 3 questions.
Just a final question about politics, because I know the conversation about the presidential election is front and center here in Sun Valley. What outcome do you think would be best for the economy and for your business in particular?
Well, I'll make an analogy. I went to West Point and I played football, and I want Navy to win 364 days of the year. But on that one day when they play Army, I want Army to win. And so I'd be lying to you and being, less than disingenuous if I didn't say our business would benefit from a Republican administration. There's more capital markets activity. There's more M&A activity. I want our country to be very strong and vibrant. And on one particular day, I'll be rooting for one particular party.
All right, ladies and gentlemen, that is a wrap. You heard it from the CEO, Anthony Noto himself, guys. A lot of good gems in there. We could start by, we just had the short reports yesterday, 2 separate, downgrades, lowering the stock price. Talking about credit quality, he said they love what they're seeing from credit quality right now. So that kind of just puts that short seller to rest right there. Boom, done. Okay, and the stock is going green right now. You also had him talk about what we could potentially do in a lower interest rate environment when we get lending back up. Because remember, guys, lending is going to have negative growth for 2024 this year, but the entire business as a whole revenue is going to potentially grow to 20% range. He said next year we're going to have, financial services and the tech platform and lending, back in business. So both of them combined together. And if you get lending growing at, 15 to 25%, you're potentially looking at 30% revenue growth for 2025. That is exactly what we want to see, guys. We want to see this company just grow massively. And if you get more top line revenue growth, you're going to get more bottom line net income profitability. So we may potentially be looking at, $400 to $600 million in profits, just next year alone. Okay. This company is just in the early stages of, profitability and durable growth. Okay. If they can grow at 25% for the next decade, this is going to be an absolute monster in the entire, fintech, banking, space. Okay, and if Galileo gets on track as well, and we sign over these legacy, platforms, which he didn't even talk about that today at all. This is going to be, potentially what they've been looking for, the AWS of fintech. Okay, and that's exactly what we want to see. We want to see that tech hybrid multiple, that banking as a service multiple, and of course, guys. He also talked about, what administration, that he wants. He wants to go Republican because you're seeing more M&A activity. I mean, look at the fintech, market right now of companies going public. There's none. I mean, these companies are sitting, on the sidelines. There's no M&A activity right now. Valuations are dried up to a crisp. I mean, we want to see, what we were seeing, when we had, those lower interest rate environments again. We want to see, the money start flowing, multiples start, driving up higher. Okay, so there's a lot of good things. Drop a comment. What did you really like? Looks like from reading your comments on Twitter, a lot of people are just liking the transparency from Anthony Noto, the boldness that he really came out with. And obviously right now the stock market is really liking what they're seeing, and this is 20%, 19% short stock. So there's a lot of shorts in this bad boy right now because of macro, because of the environment. That's why he said he really thinks the stock is suppressed. So once again, guys, drop a comment. My name is Kyle. We're going to be keeping you updated daily. Have a great day.